We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Ted Oakley. He's an author and also the founder and managing partner at Oxbow Advisors. Thanks for joining me today, Ted.
Thank you, Tom. Glad to be here.
Excellent to have you. So I'd like to start by maybe giving us a bit of your background. I understand you had quite a modest childhood growing up and have built this company from the ground up. So could you give us a short overview on that, please?
Well, I'll be happy to. I'm sure there are so many people out there that had it a lot harder than I did. And I always think about that because I'm pretty humble when it comes to things like that. But no, I started out with zero. I mean, we didn't have any running water. We didn't have indoor plumbing. We were in a little bitty shack up in the Appalachian Mountains, very, very northern Georgia. And my dad was sort of a minister, missionary type guy. And so we just didn't have anything. And then he decided he was going to go out and Greeley, Colorado. And this was when I was probably 10 years old, and try to take care of I think minister to all of the sugar beet workers and that type of thing. I think we lived in about 600 feet. We had 5 kids. We lived in half of a basement in that church, and we did have running water in that church, in that basement, but and then we ended up back at a couple of places in Texas, which is where I ended up. But the big thing about all of that is I think all of your people and your audience would, I'm sure many people like that had to overcome something to get to where they've gotten to. And I so admire people like that. And I know so many people like that had to overcome so many things. And so I'm not unusual in that respect. However, I have 2 of the largest foster child foundations in Texas, which I formed many years ago. And that was because as a kid, I had to work from the time I was 6 years old. So I never really got much of a childhood. And that's okay. That was all right. I learned a lot. And so but I did learn enough to get educated. I knew I had to get educated. And so I got very educated. Ended up in New York City and then back in Dallas and back in Austin. But that's sort of a short version of spending a lot of time trying to make it.
So as I was saying, you're the founder and managing partner at Oxbow Advisors, and you guys say you have what you call the Oxbow Principals. So can you share with us what those are, please?
Well, the Oxbow Principals are this, and that is, one of our bigger, a lot of our clientele are business people. And so, from our standpoint, we want to have the best type of company that does exactly what that particular investor needs. We're not trying to sell them anything they don't need. And I'm paraphrasing a lot of this, but it's important to understand it this way. And that is, you want preservation of capital. You're going to earn it one time. And with that preservation of capital, you need to be able to deal with people that have your interest in mind, even if it's not beneficial to us, if that makes sense. Because I tell everybody, I said, you're going to have to make sure you do what people need for them to make it successful for them. That may not be what Wall Street's looking for, but you need to be able to listen and hear that. But and that brings with that integrity and a sense of well-being and a fairness to how much money you make in this. So that's where we are.
And of course, you and I are speaking here on June 1st, and I understand that we're waiting for the jobless claim numbers to come out by the end of this week. So what does this tell us about the real economy, Ted?
Well, I suspect, Tom, that they will be better just because they were so skewed last time, and people missed it a lot. I would not expect that this time. And one of the things I've found about these numbers is, in one respect, they're just numbers. I mean, we still have, I think they're in some ways really inaccurate because you don't know how many people are really even in the workforce, or could be if they put enough money. And then how many people are working part-time or for cash. So there's a lot of that going on now that you really, it's hard to measure right now, because I know a number of businesses where, and I just happen to know this, where people are still on unemployment, but they're getting paid cash to be there. And so, there's things happening where we can't get a perfect read on this, but I suspect it'll be a better reading than we had last time for sure.
So why is it also going to be important to see how much of the American Jobs Act and American Families Act actually gets passed here?
Well, I think one of the problems about it is, if you look back in the era of the FDR in the 30s, one of the things about the jobs work then was that they tied you got paid, but you got paid for doing something. You were creating something that was for the good of the country, the good of the city or the state. And what I'm noticing in a lot of these things that we're doing now, we're not getting anything on the other end of it. And I'm not saying we shouldn't help people. Believe me, I grew up as poor as anybody. But what I'm saying is if you're going to do that, at least try to build a self-esteem into that person that, hey, I'm creating something for the good here and I'm getting some money for that. I understand that. But this idea, I think, of just paying everyone just to stay home is not a good, really a very, very good equation for success in the long run.
Well, and it has all kinds of downstream effects, right? Like look at the supply chain issues that are partially due to the fact that people would rather stay at home than make less money by going out and having an entry-level job, right?
Oh, true. Totally. I mean, I obviously we're in touch with business owners in 30 states, and it's all the same. I mean, every one of them basically tells me the same thing.
So this week is full of numbers reporting, Ted. And June 2nd, we're also going to see mortgage applications and mortgage rates come out. So what are the main considerations for the red hot housing market with these numbers?
Well, I think what will happen in the housing market, and this is probably where I differ from people a little bit right now, but obviously one of the things you're going to find in the mortgage apps is this: we talk to a lot of people in the mortgage business just to know exactly where we are, because I sort of hate to say this, Tom, but when you talk to public companies, you're not going to really get the real scoop. And so what happens, you have to talk to people on the front lines to find out. And what we found is that in the last 2 months, we had a big decrease, and we go around to banks and mortgage companies and talk to them, and we've had a fairly big decrease in refinance because just that tiny move in rates, 3/8 to 1/2 point, has caused a problem. Then the second thing is that we are getting a few more new mortgages, but I think we're past the point of peak mortgage growth, because I think what's going to happen is the prices you can only do so much. And so if you think about it, if I'm a 2-earner family and I have a mortgage today, I take it out, and let's say home prices don't change and they go up another 15% the next 2 years, I can't get a buyer for that at that point because they can't afford the payment. So see, it's sort of going to hit a wall here somewhere. I don't know exactly how, but it will look like that.
So as we're talking about the release of all these numbers, Ted, we got a bit of a shock in May when the Fed announced, or the Fed had underestimated the rise in CPI. Was this a surprise to you?
Not at all for us. In fact, we thought we would get May, June, July. We thought all of that was going to be between 3.5 and 4.5. Because if you looked at what we're comparing against, it almost had to be. And I think that's why they keep using this word transitory, which I think is a poor word, by the way. But it almost had to be that way, Tom, because if you look at what you're comparing against, there was no way it couldn't be that if you were even alive, hardly.
And of course, you're comparing against basically the economy that was completely shut down. In a way, you're saying if you were even alive, which the economy almost wasn't a year ago, right?
Well, you'll hear this term base effects all the time. You'll hear people say that all the time. Base, well, that's what that means. Basically, the base of where you were coming from, May to May or June to June, was such that I think people have forgotten how bad it was last May and last June. But if they could remember, they would see how it's fairly easy to get those numbers in there. And those numbers are probably, more than likely understated too, the ones we're coming out with right now.
Mm-hmm. So something that you wrote was that the real thing to watch in producer and consumer prices is not just the first price increase. If the first price increase doesn't change the consumer habits, it will make the manufacturers less concerned with raising prices again. So can you explain that a little bit more to us, Ted?
Well, I've always thought business would take what they can get. And I'm not saying that's not a disparaging remark. It's just the way business is. So if I own a business and I raise my prices and my demand stays relatively easy or about the same as it was, then it doesn't deter me from saying, well, you know what, I think I'll raise it a little bit more. And that's what we're finding right now is they'll raise the price and then you come back and they raise it another time. And that usually goes on until somebody says, hey, I can't buy that right now. But we don't have that right now. That hasn't happened.
So basically let's say the consumer behavior isn't affecting the manufacturer's pricing, right?
Not yet, because, it's interesting a lot of people get hung up on inflationary things thinking we have so much demand for stuff, okay? And that's what's causing the price increase. Really, what's causing the price increase is we don't have any supply. I mean, if I'm normally selling 10 widgets, but now I'm only selling 2 because that's all I have, then whoever is out there is going to say, well, I'll pay more than the next person for one of those. And you see, that's more of a supply. People don't think about that, but that's a supply-driven inflation, not demand.
Mm-hmm. So to kind of take the other side of that, though, Ted, aren't we also seeing shrinkflation? So couldn't that be kind of pointed at as a counteracting force to, let's say, the consumer behavior?
We are. In fact, I'll send you, Tom, or you included a graph we did in our quarterly call. It was a shrinkflation graph, and we only put on there. We actually had 200 items that we ran. My research department ran from 1 year ago, which was April to April, that had changed in size. We put about, I think, on this page you'll see maybe 20 or 25, but we see it in everything, and it's unfortunate, but I think that the consumer, obviously the last one to know, hasn't been noticing this. But I used it in that particular comment on that quarterly review. I said, hey, where I first picked it up was I don't eat a lot of candy, but occasionally eat a Snicker bar. And I said, 5, 6, 7, 8 years ago, I could get a Snicker bar, and it was really it was a bar. And now it's like 2 bites. It's a little bitty Snicker bar now. Same price. So and once I had that, I started thinking about it, and I had a research department. We had 200 items we pulled up in a 12-month period.
Yeah, and of course that's just the decreasing quantity for the same price, right?
Oh yeah.
So as you're referencing your quarterly call, you shared 3 possible outcomes of inflation and the likelihood of each. So could you share with us what those 3 outcomes could be, Ted?
Well, I don't think we're terribly bright to be the people to think of totally, but I mean, there's really only 3 things that could happen. And one is that the Federal Reserve is correct and that we get through the summer, sort of things get rolling again, employment comes back. And so by the fall, inflation is what they call transitory. And so what happens is that's one scenario. So things settle back down, and it's sort of business as usual. And you don't have any major breaks in the market because of that, because they're still funding, and still buying bonds. That's one thing. The second thing, and that's probably we gave that a maybe. The second maybe was that they have underestimated the transitory part of it, and the numbers go higher than they expect. And now they're caught between a rock and a hard place. So they have to make a decision. Okay, are we going to let it run hot and inflation keep on going, which really harms the economy at that point, you see? Or we're going to raise rates, which also really harms the economy. And we give that a maybe too. We think the Federal Reserve is fairly naive to what goes on in the real world. And I was interviewed, and a guy asked me what I thought about the Federal Reserve. And I said, well, the last Federal Reserve president that I trusted was Volcker. That tells you how long I've been around, for one. But two, the rest of them all been just give away money. And just so you can't, I think that whole board doesn't know much about what goes on in day-to-day life. And so that could sneak up on them. And we give that a maybe. One of those is probable, one of those first two. The last one is a 70s style inflation. Now, a lot of people in the business weren't around in that time. I was. And so I started in New York City in 1976. And so that whole next decade, was like that. But what happens is I don't expect that. And I'll tell you why. I think we have so much debt in the country, not only nationally, but individually, that if you were to get into something like that, we would almost have a major depression. And that would be the least likely of those three to happen, but it would be one of those three. It has to be something that falls in one of those categories. So we'll just have to see.
Of course, as you bring up Volcker, he was basically famous for breaking the back of inflation by raising interest rates. And that seems to not be a possibility now. And how do you see that, Ted?
Well, Tom, you're totally right. There's nobody there is going to have the fortitude to do that. First of all, Volcker was a non-political animal. And some of your people may remember this, but the man on interest rates at that time was a guy named Henry Kaufman. And he was the guy who would call the moves in the market and that kind of thing. And it was interesting because Volcker, I know Reagan called him in and said, hey, we really want you to lighten up here on this. And he did not do that. He ran it into recession. But it worked. He put us through the cycle and it worked. Now we have nobody with that kind of fortitude. I mean, if you look at Powell, I mean, if the wind blows the other way, he switches. It took him all of 4 weeks or 5 weeks, at the end of 18 to turn on a dime. So I don't expect that, and I'm not certain they can at this point, because if you're thinking about all the debt we have and what their balance sheet is, I told the guy last week, I said, what they may end up doing, Tom, is just maybe they just end up like Japan and just carry a big balance sheet forever. And I don't know, but that wouldn't surprise me.
So Ted, when we talk about CPI, there's another, let's say, complementary metric called the PPI. Could you explain to us what the difference between those two are for those that aren't familiar?
Well, the producer price index really is what we used to call it, the wholesale price index. That was the old term for it. And that's really what it is. It's if you see purchasing managers and who they buy from, how they buy, that's how they come up with that index, the consumer price index. And it's a bit of a misnomer in a way on the consumer price index, because if you go in and look at it closely, a lot of the ways they figure that particular CPI has to do with sizing and a lot of different things that don't necessarily, come through in your mind. Because I think everyone knows if what I'm spending, I'm speaking for people now, what they're spending on gasoline and food and rent and cars and insurance and medical, it's all higher than 2%. That's for sure. And so I think everybody knows what game they're playing on that one. But that's the difference. I mean, the wholesale price index is probably better to watch because it's hard. It's a little harder to jiggle that around than the other one.
So as you pay attention to this, the PPI, or as you're calling it, the wholesale price index, what kind of breaks do you let's say watch for that are instructive to you?
Well, we like to look at a moving at like a 3-month or a 6-month moving average, because if you get into these month to month, you pull your hair out because you can't tell much about it like that. But if you look sort of at a trend, then you get an idea about what's happening. And I know the last 2 months, people are going to say, well, that's not a trend. And it's not, but it could be the beginning of a trend. And so that's what you have to watch. How do the follow-on months stack up with, in other words, with these 2 months? I mean, we have a large computer base and we run a lot of rate of change studies on things. And what we're looking for is and we front weight whatever that front one is so we can get an idea. What's that rate of change doing? Is it starting to change, or is it actually changing the other way? Converging or diverging. We're looking at both.
So if we think about wages moving up and profit margins of big companies moving down, what does that signal to you, Ted?
I hear a lot, Tom, about this, about, wages go up. And so if we raise the minimum wage, it's going to do this or that or the other. What I've found in companies, the really good companies, they already pay their employees well, so they don't have turnover. And I think if I were looking at the public companies today, I'm very critical of them, by the way, on this subject. And that is, if you take the top 300 to 400 public companies, and I'll venture to say that 90% of the CEOs and presidents and chairmen of those companies never had to meet payroll privately. Okay. So for them, it was just a method of moving higher. So they get paid these exorbitant amounts. And if you look at the spread between upper managements now and what they pay, it's ridiculous, really. And if you really want to build a good company, to me, okay, and that's what we do in our company, you pay your people really well so you don't get turnover, you get a tremendous amount of loyalty, and they provide a really, really good product. And what I see is people that are trying to go the other way, let's keep it down as far as we can. And they've been able to do that, since 2000, but I think it's going to backfire on them now because it's gone so far, and you push people so far out to where they don't have any money to get by week to week that they're going to go back the other way on you now. So we'll see if that happens that way. But I think by and large, I think companies brought it on themselves. They could have done a lot better job than what we see now.
Is it possible that wages must go up simply because the cost of everything is going up, though, Ted?
I think they'll go up because for you to get good help, you're going to have to pay to get somebody else to leave that company and come to your company. And then you get into these situations where, I'm willing to say, well, I will pay you 25% more to come over. I hear you're good. You do a great job. That to me is where we eventually head with all of this. Your business picks back up and you really need good help. And you're saying, I'm willing to pay for it now.
Mm-hmm. So when you look at the equity markets, Ted, you've said that you use 10 to 15 factors to determine how expensive the market is. Could you share with us what some of those factors are?
They are. We start out with, on the equity side, now we run 4 strategies. But on the equity strategy, what we're looking for there are companies that we feel like can grow at 15% a year over the next 5 years. That's I know it sounds kind of basic, but we find that if you go through, for example, the top 500 or 600 companies, there's not that many companies that have the ability to really consistently grow at 15% a year over the next 5 years. And so that's one of the things we start with. But in addition, what we do with that is we have a criterion that we'll discount that back for inflation to a present number and say, well, with the market, if the market's willing to pay 12 times, 14 times, whatever number we're using for that set of earnings, then the third criteria we use is we want to try to buy it at a 15 to 20% discount to that number. And so we have to be in a situation where prices are fairly cheap, but we look at other things too. We're really, really big on debt to equity. You find that companies with a tremendous amount of debt and not a lot of cash will really hurt you in a downturn in the market. So that's another criteria we really lean on in a really, really big way. Of course, we look at management. A lot of the management's changed though, and what we don't need to talk to management. We can pull what we need to from the numbers. And so those are probably 4 or 5 things we look at. And we obviously look at price to sales, we look at inventory return. We look at a lot of things that are in that mode. It's big for us on how much cash is on the balance sheet. We want to know if companies are going to make a lot of money, number one, and they have enough money to get through the valley if something happens. But on the equity side, that's generally what we're looking for.
So Ted, just as a little sidebar there, when you're talking about trying to value these companies and find companies that have this 10 to 15% potential for growth, how are you measuring that growth? Is it growth in share price? Is it growth in profits per year? How are you thinking about growth?
Good question, Tom. We're looking at raw profit. You can really, I could give you 100 companies right now, you'd know every name, that are making more money today than they were 5 years ago per share. Mm-hmm. But on an absolute basis, they're actually making less. And that's what the problem with all of what the Federal Reserve has done with all this free money is allowed these companies to finance everything and then do these huge buybacks because they don't have to spend the money on debt now, so they could do these huge buybacks and can make it look like artificially that share price is doing well. And they have all these reasons why they're buying it back. But I've always said to all of them, I tell you what, if you're so good at running that company and you have some extra money, why don't you pay it to me as a shareholder? I'll take the money. And we'll not worry about your stock options for the time being. We'll just worry about us as, shareholders.
So going back to these 10 to 15 factors for looking at the equity markets, Ted, considering that it seems that the equity market is so overvalued, is this part of the reason that you're so positioned or have such a large position, what would be considered a large position in cash right now?
Well, it's not that we're trying to time the market, Tom, but what happens is, I'll give you an example. We run the screens on about 200 companies in the equity portfolios. We probably don't have more than 4 or 5 right now that meet the criteria. Now, if we already own that stock for somebody and it's really high in price, we're not necessarily going to blow it out because it's there. Because most of these companies we want to own for 5 years, but they have periods where they're all overpriced, and they'll have periods where they're all underpriced. I'll give you an example. Last March, for example, all 200 were priced great. We get bought anything. Now, maybe 5 companies. And so that's an automatic, what I call, like a governor on an engine, where it keeps you in line, because if prices are so high that they don't meet any criteria, you automatically have more liquidity, which means when they do fall back into the normal range, which they should be, you've got some liquidity and then you can take advantage of it. This idea, and Wall Street sold this really big the last 10 or 11 years, because we've had a plug and play market. You just put money in and you don't even have to know anything about this business, and you'll be doing better at the end of 10 years, 11 years. I don't think it'll be that way the next 10 years. I think you'll have to do business with people that know something about what they're doing. They're not just, hey, we're going to buy you 10 ETFs over here and hey, you're good to go.
So as you see some of these positions really appreciate, Ted, do you guys have any set rules, any set framework to layer out of a position, or how do you decide when to take some of those profits?
It depends on the company, Tom. I'll give you an example. We've owned Microsoft for a long time, and it's one of the mistakes people make in running money is they have this idea that, okay, well, if it gets up to where it's more than 3 or 4% of the portfolio, I need to diversify. Well, maybe not. Okay, maybe if you have a really good company, why not let it run to 10 or 12% of the portfolio? I mean, what are you going to do? Sell it and pay tax on it and go find one that's not quite as good? Those don't make any sense to us. So the only time we do that is if they reach a target that we had for maybe 3 or 4 years out. We may not sell the entire position, but we'll trim it a little bit, because that tells us that we're really way ahead of where we should be. And there's one other reason. If they make a left turn when they should have made a right, and you can easily see it, you can say, this coming, we don't, they brought in a new person and they're going the wrong direction here. We're gone. And so that's another reason for us selling. But we're trying to own most companies for longer than 5 years. Where people, I find this to be true with most people, they buy something and they're okay in a portfolio, but they keep selling it and keep paying tax on it. And what you really want to do is you want to have those gains build on top of gains so that you get to ride the tax, if that makes any sense. You don't have to pay it. You'll pay it eventually someday. But the true wealth comes from owning good companies and staying with them for a long period of time.
So considering your different strategies here, Ted, how do you expect gold to perform in this environment, and what role does it serve in your different portfolios?
Well, we have, just to give you an example, Tom, we have 2 stock portfolios, a growth portfolio and a dividend portfolio, all common stocks, by the way, in each one. We own gold in the other 2 portfolios. We have a conservative income portfolio that's really, really, really bulletproof. And we hold a lot of really conservative, close to the best money in that. We own gold in that. And then the other strategy we have, which is a fairly large strategy for us, called a high income strategy. And we can buy, it is a strategy designed to beat the bond market, always, and it always has. And we own lots of things in there that cover a wide array. We're overseas, we own energy, we own gold, we own our real estate investment trusts, preferreds, convertibles. It's got to have a lot of cash flow to it. But in both of those income portfolios, we do hold gold and miners, because that's where you really get hurt in an inflationary environment, is if you're looking at a fixed income portfolio that's dead still and everything's running away from you, and your buying power just is dwindling away from you. And so you need to have something like gold. You could have other things. I mean, you could have other metals. I just think you have to have something to offset that.
So what types of strategies do you employ, or what types of companies, ETFs, what are your preferred ways to invest in gold?
If you look, normally what we do is we do have some people that want to own the bullion straight up, and I really think that's fine. The problem for us is we run about $2 billion, and we can't, since we do a lot of separately managed accounts. A lot of the people we work with do not want to own physical gold, but they have to take care of it. Okay, so we can choose one of those sources. We look at iShares or IAU, or some people want to use GLD. We don't use that particularly, could, but we're trying to find situations where if we as a firm, you have to have quite a bit of money in these to make this work, but there's a limit there where you can convert that into the bullion if you want to. Most individuals don't get to that level, but us as a firm, we can get to that level. And that's how we handle most of it, even though we do have some that are that are the physical gold. And I like the physical gold better. The problem is when you're dealing with a lot of people, they can't do it. That's the problem.
So what about when you're investing in miners? What are you looking for when you're looking to deploy capital in that sector?
Well, in the miners section, we trade off of those a little bit more than we don't. Like when they get to the upper end of the range, we'll take something off of those, put it back. The reason why is because now they're all coming around now. They're all starting to, not all of them, I'd say 65 or 70% of them now have positive free cash flow, which is, they've had a tough time, prior to the last couple of years or so. But they really, one of the things that allowed them to do was really clean up the balance sheet, get the debt down, so that now they're really, really leveraged to the upside in price, silver and gold companies. So on the miners side, the miners probably are going to be really leveraged to the upside because their balance sheets are better, their free cash flow is better. But you have to add in there something like a Wheaton or Franco-Nevada. For us, it would be one of those two, maybe a Sandstorm, but something where you have a royalty override. Because if you think about it and something's going to go way up in price a lot, you want to be in a position where you're not in the capital equipment side or the capital investment side. You're just managing from that standpoint. It's very similar for us. We own a company called Brigham Minerals, which is an oil royalty company, very well run that's the same way for them. In other words, we want to own the royalty side where you don't have to spend money on capital outlays to go do any more drilling or for metals or for oil. And so I think you have to mix those together. I think you have to have a couple of miners, and then you have to have a couple of royalty people as well.
How do you go about valuing the companies in the royalty space, Ted?
We look at free cash flow, and we also go back and look at a similar. What we've done is gone back to highs in the market for some of these companies were really high. Sometime back, and they have room to move now. Now they're getting back up higher again, but you would think with gold at 2,000, for example, that some of these companies would be higher than they are. And I think what happened is people have to be willing to say, okay, if we are at a 2,500 price or 3,000 price, what's that free cash flow going to look like? And that's how you have to buy these companies. And it's interesting, they will obviously when everybody else falls in love with them, which by the way is not now. If anything, people have gone the other way now. They're like, it's had its run and not going to happen. But right now, I think people have just, we still have some hardcore gold, but everybody got off from cryptocurrencies and this, that, and the other. But I think if they will stop and look at the companies, if they'll look at their debt relative to where it was, say, 7 or 8 years ago, particularly 2011, and they'll look at where their free cash flow is and where it's going, I think they can make a case for looking at it. There's a lot of their multiples. Some of these companies, a lot of their multiples are, and we don't buy the juniors much because we don't. I know there's a lot of money to be made in that. If you look at, there's a number of people. Martin Catuzza, I know. I get Martin said, I get his research and Octavio. There's people out there that do the small one. I don't. We don't. But I mean, that's because we need the liquidity. So that's where we come from.
Mm-hmm. So can you share with us some of the let's say the factors that you look at when you're trying to kind of time the market? You said that you repositioned in the miners about 8 weeks ago. So what helps you give confidence in that choice, Ted?
Well, if you remember, they hit a peak back in, August or September of last year, and gold did too. And so what we did is you got to remember now, we had been in there for a couple of years prior, so we had low prices, and we took some off, but we came back on this corrective mode that we had, it finished up, I guess, about, what was it, March maybe? Everything was correcting to about March. That's when we came back and put a lot of our hard gold back on. We're not going to be in a situation where we don't have any, but we do trade around it some, though. I think in any commodity type thing, it's not growth stocks, but commodity, they usually do this. They go to extremes both ways, and when they're going to one of those extremes, they're usually going to come back to the middle, and you can sort of tweak your positions like that a little bit.
So something you and I were talking about before the call, a chart that I came across of yours that was quite interesting was gold really accounting for the let's say the loss in value of the paper currencies. Does gold really serve to really kind of adjust for the value or the loss of value of these currencies, Ted?
I think what happens is if you look at all the countries where that's happened to them, where really all their currencies just got exploded and they weren't near worth as much money as they were before. People are always looking for something that's stable, that doesn't change in value. And I'll give you an example in this time so you have all these people out there thinking about all these 4,000 crypto coins that are out here. But if you think about it, that's an infinite amount of crypto coins that can be produced. I'll just do another crypto next week. That's not the case with gold and silver. You have a certain percentage, fairly small every year that can be produced, and that's it. So you have a stable market, and you're not going to, unlike cryptocurrencies, you're not going to walk in here one day where you had Bitcoin go from 60,000 down to 34,000. That won't happen to gold. I say it won't happen. If it does, we're in bigger trouble than we realize. But that's the difference in that. It has a stability factor that goes back many, many hundreds of years. When all of these currencies, and you go back through the history and look at a lot of different currencies that go blown up, but the people that maintained what they had a lot of gold, because it doesn't change that much. And I think that's what you'll see in the chart I sent you. Two things happen, and that is when the currencies are declining and they're losing buying power, you'll see, and in those modes there, that's when you see you see gold does better.
So as part of your strategy, Ted, does the possible upside of silver or silver-related equities appeal to you, or do you see it as being too volatile or playing a different role to you than gold?
It's a different role, Tom, in that it's used in the industrial world. That's the difference, and it could be, it's already done really well, and we don't own silver per se, but it could, it could do just as well or better because you also use it in the industrial world. So it is more volatile. It's going to have a higher volatility rate than gold, but that volatility could be positive too. We just don't happen to own it, but I can understand why people do own it.
Is there any particular reason other than just volatility that you don't own it?
Well, for us, really, we look at gold as more of a standard for currency debasement than we do silver. You never hear anybody saying, well, I'm going to own a lot of silver because I'm worried about the currency. And that's not really what you see. We find most people own gold, and that's their thread against currency debasement.
So when we compare the S&P to commodities and see that they're really near all-time lows, are you positioning yourselves in other commodities other than gold and silver?
We do. We have, of course, we have a lot of energy, and we had a lot of energy last year when nobody liked it. And it's done really, really well for us this year. So we have a lot of oil. We have oil royalty. We have gas pipelines. I think people underestimate natural gas. And then we have timber. And then we have fertilizer. And obviously we have metals. Now we don't have uranium, even though we're really interested in uranium. But we try to cover that whole, that whole spectrum because from the lumber standpoint, the one thing about timber companies, it's not just about lumber for homes. You have a lot of things that come through those paper, there's so many things come out of timber companies. And so you have to try to look at that and those commodity levels. The problem about, a company we've always wanted to own, but it's always too expensive on the food side is Archer Daniels Midland, but it stays too expensive for us. But there'll be a time there when those companies that we like, some of those foods and that sort of thing, they'll come back into where we want them, where we could justify buying them. But right now we just have, we have fertilizer, we have timber, we have gold, oil, natural gas, royalties. That's sort of the spread we have in those. And all of those pay cash flows, which is one of the things we're looking for.
And of course, as a comparative to the S&P, they're all, or that the commodity complex as a whole is really basically at an all-time low almost, right?
Oh yes, I sent you another chart. It's a 30-year chart, but I could do 80 years. It's the same because, and this has gone on throughout history. You have periods where financial assets get way out of line, and nobody wants to own hard assets. And it's interesting too, Tom, if you look at most of the people around today, like the average portfolio manager is 48 years old or something. If you take that age and less, they know nothing about commodities. It's like I don't know, I buy it at the grocery store. They don't have an idea about a real commodity cycle. My first job before I went to Wall Street was buying soybean oil for a company called Anderson Clayton Foods. You'd have to be an old timer to know that one. But it was in that really inflationary period. And this is no lie. You go out and buy soybean oil because you had to make margin and shortening. And if you missed it by a day or two, and you had a product to sell on the far end of the grocery stores, you just lost money. And that's what happens in inflation. And you come back next week, guess what? Soybean oil is gone again. And here you are trying to price out, and the stores out here they're like, hey, no, we got to charge this. But you know what? This next batch is going up. It's just, people don't realize what happens in an inflationary atmosphere. While I don't think we'll get to that period of 10, 11, 12, 13, 14, like we did then, all you need is about 5 or 6. And you will blow people's mind, I think. I just don't think you don't have anybody that experienced at doing that. And you have all these people in the bond market, they've never seen anything like that. So, it'll be interesting to see how they react.
Is that not part of the purpose for the futures markets, is to kind of not dampen, but make that pricing a little bit more stable?
Well, it used to be, Tom, one of the things that happened for many, many years is the futures market was really designed for the producers of the product to be able to settle the thing down a little bit. So and we used way back in the day, we used them at that time in the product. Well, now you fast forward in the last 15, 20 years, what's happened is they became financial trading markets, a different thing. Okay. And so you change the system a little bit, and it's harder, I think, to settle those markets down now than it used to be, because what can happen is all these financial people out here, not commodity people, but financial people, they dip into this market and they can run it up or down on you, and for no reason at all, just for a price move. They're not planning on taking product, I can tell you.
Excellent, Ted. Do you have anything else you'd like to share with our audience before we wrap up here?
Not really. Tom, we do a lot of business. Most of our business is done, with people that have sold companies. And I've told, we've put out, we have a number of books about that, but we've probably done 3 or 4 videos the last couple of years. I'll say the same thing this year, and that is, if you're a business owner in Canada or the U.S., and your business is probably valued as high today as it ever will be in your lifetime on a multiple of pre-tax. And my advice to you would be take a hard look at that. Now, I've worked with thousands and thousands of business owners after selling the companies, and I know a lot about value in private companies, but they've never been like they are today. And our advice to people today is if you think you might sell it in the next 2 or 3 years, you probably ought to sell it right now. That'd be my advice to them.
So Ted, in a way, is that prudent advice considering, let's say, your possibility or the likelihood in your mind of another major correction here coming?
Well, that's another thing. I think if rates go up and money slows down and you don't have as much money out there, I don't think they're going to be willing to pay the multiples they are today. Most of the private equity companies today are paying multiples. I'll tell you, the average is somewhere close to 12 now. I mean, that's ridiculous. There's so many companies they're paying these multiples for. And I'm seeing them pay 4 or 5 times revenue, forget the earnings. And I've even seen tech companies paying 10 times revenue. Well, what happens is they're basically never going to get their money out. So if you're owning the company, sell it to them because you know what? You can go start another one if you have to or something else, but you're probably never going to get that kind of pricing. That is this will be an off the chart moment, I think, for people to sell their companies.
Excellent. Ted, of course, you guys are available at oxbowadvisors.com and at oxbow_advisors on Twitter. Anywhere else you'd like to have people find you, Ted?
Well, you certainly go on YouTube. We have so many things that go on YouTube. If you go to Oxbow Advisor YouTube, you'll see so many of the interviews. A lot of the people you interview, Tom, Danielle is a good friend of mine, and Jim Bianco is a good friend of mine. A lot of people you talk to, and so I know a lot of people in the industry and a lot of smart people. I learn from all of them. I try to learn something every day, but those are the main places. They could certainly come to oxbowadvisors.com and we'll be happy to put them on an email. They don't have to be an investor of ours. They'll get everything we do, from our quarterly letters to our quarterly calls. We do them live video, and then we do a lot of interviews, a lot of really good interviews. In fact, we probably have coming up in a few weeks, we probably have maybe one of the best real estate interviews that they'll see this year. So anyway, a lot of good topics for business people.
Perfect. Something to look forward to. Ted, thanks so much for your time today.
All right. Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.